Okay, we are diving deep into Manhattan Associates, MANH, their Q3 2025 earnings call, which happened just after market close on October 21st.
And wow, what a call. I mean, this is really a classic market paradox playing out.
Totally. You look at the numbers in isolation, you probably guess the stock popped maybe 5%. They had really strong financials, beat estimates everywhere.
Beat on top line, beat on bottom line, raise the full year guidance, everything you typically want to see.
And yet, the stock just tanked immediately after the print, down, 9 to 11% almost right away?
Yep. Significant sell-off.
So that's what we're digging into today. We need to unpack the numbers, the management talk, and figure out what's really going on. Why punish what looks like, clear outperformance? Is there something hiding? Or is the market just jumpy?
Well, let's start with those headline numbers because honestly, they were pretty impressive on their own. Non-GAAP EPS, $1.36.
Which was way above consensus, right? Street was around $1.18 and $1.19.
Exactly. A really substantial beat on earnings.
Okay. And the top line.
Revenue also came in ahead, $275.8 million. That's up 3.4% year over year, also a beat. But maybe the most important signal looking forward is the pipeline.
The RPO.
Right. RPO bookings grew 23% year over year. They ended the quarter with a backlog of $2.1 billion.
Okay, hold on. Just quickly, for anyone new tuning in, RPO, remaining performance obligation.
Yeah.
Basically, it's revenue they've already contracted, already locked in, but just haven't booked yet.
Exactly. It's their committed future revenue stream. So $2.1 billion is, well, it's huge. Gives them a ton of visibility.
So great numbers, huge backlog, raised outlook.
Yeah.
But the stock falls off a cliff. It tells you investors latched onto something else, something subtle, maybe.
It really seems like it. And digging through the call, the likely culprit, or at least the focus of the concern, appears to be the services side of the business.
Okay, let's break down the revenue streams then, because the cloud part looked great.
Oh, yeah, the cloud engine is really humming. Cloud subscription revenue hit $104.9 million. That's strong, 21% year-over-year growth. That's the high-margin recurring revenue story everyone loves.
But services, that's where they actually implement the software to get customers onto the cloud platform. That part didn't look quite as good.
Correct. Services revenue was $133.0 million. And that is down a bit from the $137.0 million they did at the same time last year.
Okay, that was the explanation there.
Management pointed to sort of customary budget constraints at clients, things shifting around, work phasing differently. They did specifically say about $2 million in services revenue got pulled into Q3 from Q4.
Okay, I got to push back there a bit, though.
Mm-hmm.
I mean, they can call it phasing, minor budget shifts, but isn't the market's fear here actually pretty rational? Like the worry that macro headwinds are slowing down these big implementation projects.
That's the crux of it.
If companies are pausing or delaying big supply chain overhauls, that services dip isn't just timing, right? It could be a sign of friction.
You've hit the nail on the head. That's almost certainly why the stock reacted like it did. The market seems to have zero tolerance for any sign that cloud migration momentum might be slowing down, even a tiny bit.
Especially given past issues.
Exactly. That memory of previous execution hiccups, it just makes investors really sensitive. A slight dip in services, and boom, the fears resurface.
But financially, fundamentally, the company is solid. This isn't a cash crunch situation.
Not at all. Far from it. Profitability looks fantastic. Adjusted operating income was $103.4 million. That translates to a really healthy adjusted operating margin of 37.5%.
37.5% margin. Wow.
Yeah. And cash flow from operations, CFFO, jumped 49% to $93.1 million. Now, you do have to adjust for a one-time U.S. tax law change benefit, about $20 million there. But even excluding that, CFFO was up a solid 18%.
And then putting that cash to work, zero debt.
Zero debt.
Right.
And they're buying back stock. They bought back about $50 million worth in Q3, 233,000 shares or so. And importantly, they just refilled the buyback authorization back up to $100 million in October.
Which kind of signals that management thinks the stock is cheap right now, despite the market reaction.
It certainly suggests conviction, yeah. And that conviction is probably tied to that visibility. We talked about the RPO.
Right, that $2.1 billion backlog.
Yep. Average contract length is stable, 5.5 to 6 years. And they expect to recognize 38% of that huge $2.1 billion RPO just over the next 24 months. So a lot of that future revenue is actually pretty near term.
Which lets them raise the guidance for this year, for 2025.
They did. Total revenue guidance now $1.073 to $1.077 billion. Adjusted EPS outlook up to $4.95 to $4.97.
And looking further out to 2026.
Preliminary view looks strong too. They're guiding for 20% cloud revenue growth next year and key point here, they expect services revenue to get back to growth in 2026.
Okay, so they're addressing that concern directly.
Seems like it. And they're also forecasting margin expansion, 50 to 75 basis points on the adjusted operating margin, even with plans to spend more on sales and marketing.
Okay, now this is where it gets interesting strategically, because it feels like the market is maybe missing some of the operational changes they're making to address that very services execution risk.
This was, for me, maybe the most compelling part of the call. They announced a really significant leadership change. Greg Betz is joining as Chief Operating Officer, COO. That's a brand new role for them.
And he comes from Microsoft FastTrack. Why is that relevant?
So Microsoft FastTrack is basically Microsoft's arm for helping big companies actually deploy and get value out of their cloud purchases. It's all about managing complex, large-scale migrations successfully.
Ah, okay. So they're bringing in someone specifically focused on streamlining those cloud conversions and implementations.
Exactly. His job is literally to build and scale the operational frameworks for conversions, for renewals, and also to build out their partner ecosystem, working with the big global SIs, tech partners like Google, Shopify, making implementations smoother, more predictable.
So connecting the dots. The market freaks out about services predictability, and MAH brings in a heavy hitter whose entire job is to create predictability in services and conversions.
Precisely. And it ties directly into their new conversion strategy. They're not just waiting for on-prem customers to decide to move to the cloud anymore.
They're being more proactive.
Much more. They talked about a pilot program they ran. A fixed fee, fixed timeline conversion offer for a specific group of their WMS customers' warehouse management.
Fixed fee, fixed timeline. That sounds smart. Takes the risk off the customer, right?
Totally. Removes that budget uncertainty, gives the customer a clear path. And for MAAN, predictable revenue, faster conversions. They said this pilot immediately generated like 30 new deals, significant pipeline growth right away.
Okay, that feels like a direct answer to the market's fear. It's an operational fix for the services wobble.
It absolutely does. And alongside that, they're also pushing hard on product differentiation, specifically agentic AI.
Okay, agentic AI, buzzword alert, or is there real substance there? What makes it different?
Well, the way they describe it, it's not just about prediction. It's about autonomous software agents that actually execute tasks within their Manhattan Active Platform. Think of them as specialized software workers.
Okay, like what? Give me an example.
They mentioned a wave agent in their WMS, the warehouse system, that optimizes how orders flow through the warehouse, and freight audit and pay agents in their TMS, the transport system, that automatically check and pay shipping invoices.
And the key advantage they're claiming is?
Speed and integration. Because their platform is cloud native, API first, they say these agents can be deployed super quickly, like in minutes.
Not months of complex integration work like with older systems.
That's the argument. No need for separate data lakes, less latency, intelligence built right in where the work happens. They see it as a major competitive edge. General availability for these AI features is slated for early 2026.
Got it. And there was a new product too, something about fulfillment.
Yeah, EPF Enterprise Promise and Fulfill. It's designed to work tightly with big ERP systems, think SAP, to help companies get a better handle on their inventory across the board and improve how they promise and fulfill orders.
A more unified view.
Exactly. And they mentioned they've already signed some big deals for it, including a major global 3PL third-party logistics provider. So it seems to be getting traction.
Okay, so let's pull this all together. Undeniable financial strength in Q3, raised outlook, this new COO focused on execution. The fixed fee model pilot showing real promise, AI differentiation. Why? Why did the stock drop 10%?
It really does seem to come back to history and sentiment. Context is key here. MANH stock had already been struggling over the past year, right?
Yeah, significantly underperforming the S&P and even the software ETF, IGV, down 30-something% leading into the call.
So expectations were likely sky high already, and investors have long memories. That huge 20% plus drop back in January 2025 after they cut the profit outlook. That pain is still fresh.
So any hint of weakness, like that slight services dip, just triggers those fears all over again. Fear about macro, fear about execution.
It really looks that way. Investors immediately jump to, are companies hitting the brakes on big projects? Even if management says it's just timing, the market hears risk.
So the stock is arguably discounted right now because of that fear, or maybe amplified by the history. But the company seems to be laying out a very concrete plan, the COO, the fixed fee model, to tackle that exact fear head on.
Which leads us nicely into our This Is Not Financial Advice segment, because if the market is mispricing that operational fix, there might be an opportunity.
Okay, lay it on us. The outrageous but plausible trade idea.
All right. The pitch hinges on that RPO acceleration. You've got $2.1 billion in locked-in revenue, zero debt, huge cash flow, a fresh buyback authorization. The market smacked the stock down because of services worries and macro fears.
Right, that's the sell-off story.
Our thesis, our outrageous but plausible idea, is that the market is massively underestimating the impact of Greg Betz, the new COO, and specifically that fixed-fee conversion model. We think institutionalizing that playbook will pull that $2.1 billion RPO forward faster than expected.
Because the fixed fee model de-risks it for customers and speeds things up.
Exactly. It removes friction, accelerates time to value. Our bet is this leads to services revenue growth in 2026 that blows past the current consensus estimate.
Which would force a re-rating of the stock because the current multiple is depressed by those execution fears. So the trade is, buy now, catching the fear, betting that the fixed fee playbook success, which we already saw signs of in the WMS pilot, gets rolled out wider and unlocks revenue faster than anyone thinks.
That's the core idea. You're betting on bets and that operational playbook to turn that massive RPO into recognized revenue quicker than the market currently believes possible. That WMS pilot pipeline growth is the tangible evidence supporting the bet.
Okay, quick recap then. MANH, strong Q3, cloud growth solid, huge RPO, strategic moves with the new COO, the fixed fee model showing promise, AI investments differentiating the platform. But the market sold off, likely fixated on that slight services dip and haunted by past execution issues.
Right. So the provocative thought we want to leave you with is this. They proved the fixed fee model works for WMS conversions. How fast can they scale that? How effectively can they roll that same fixed fee, fixed timeline playbook across their entire base, transportation management, omni-channel customers? If they can do that systematically, what does that acceleration really mean for that 38% of the RPO they plan to recognize in the next 2 years? Could change the whole valuation narrative.
Definitely something to think about.
Yeah.
Excellent breakdown. Thanks for joining us for this deep dive on Manhattan Associates. And as always, just a reminder, everything we talked about today is purely for informational purposes. It is absolutely not financial advice.